Top business stories live from the Sky News City studio. Hopes that the Federal Reserve will cut interest rates soon are dampened as US inflation in March proves stronger than expected. Global trade forecast to pick up this year, but the World Trade Organization warns that conflict and geopolitical tension pose a substantial risk. Spain scraps its golden visa scheme for foreign property investors. We'll hear from the country's biggest house builder. Good afternoon. This is Business Live with me, Ian King. Any hopes that the US Federal Reserve will cut interest rates soon may have been dashed today by higher than expected inflation figures. The consumer price inflation measure of US inflation on an annual basis came in at 3.5% in March. That was pushed up by rising food and fuel prices. It was up from 3.2% in February and higher than Wall Street had been expecting. Market expectations on the timing of the first interest rate cut from the US Federal Reserve are now shifting from June to September. Meanwhile, yields on US Treasury bonds have spiked to their highest level since November. We'll have a reaction to that later in the programme. Now, after a year in which global trade was hampered by high energy prices and inflation, the World Trade Organization is forecasting a rise in trade volumes this year and next. But it warns that conflict and geopolitical tensions pose a considerable risk. And it says governments are showing signs of scepticism about global trade, with the US increasingly turning to tech imports from North America rather than Asia. Well, joining me now is Rolf Ossa. He's the World Trade Organization's chief economist. Rolf Ossa, welcome to you. What has informed your forecast?
Well, first of all, thank you very much. Thank you very much for having me. Of course, we look at the latest data and try to identify patterns in this data. And what we predict that the volume of world merchandise trade is going to grow by 2.6% this year and then by 3.3% next year, after having contracted by 1.2% last year. And the big story here, as you already mentioned in your introduction, is really inflation and high energy prices, which have particularly affected the European economy and also European trade. So the story for 2023 is really that Europe drag down world trade, and that's going to change, and that's going to be different this year and next, and that's the big picture in a nutshell.
Very good. What kind of assumptions are you making about disruption that we've seen in the Red Sea? How long do you see that persisting?
So we have analyzed the situation in the Red Sea, and at the moment the assumption that we make is a continuation of the current situation, and the situation as we see it is of course a serious disruption to international trade, given that so much trade flows through the Suez Canal, but we don't really see it yet showing up in the aggregate numbers significantly. So we view this rather as a risk to our forecasts. So, for example, if there was an escalation of tensions in the Middle East, that would then affect energy prices significantly, then I think we would land lower than what we are predicting now.
Now, one of the big numbers that jumped out at me in what you've published this afternoon is the fact that bilateral trade between the United States and China grew by 30% less than their trade with the rest of the world. That's clearly very worrying, given that this is a real motor for global trade growth.
I mean, it's interesting because it's not that the trade itself between these two countries is falling by that amount. So I just want to make that very clear. It's just that the trade shares are moving towards other countries, and it's a broader phenomenon. It's not just limited to the United States and China. What we've also done in the report is we've separated the world into two hypothetical blocks based on voting patterns at the UN General Assembly. And what we see there also is that trade between these blocks is growing slower, 4% more slowly than trade within these blocks, which again gives us an indication that there are really first signs of fragmentation around geopolitical lines.
When the US tried to avoid buying goods from China, a lot of it was simply rerouted via countries like Vietnam. Are you still seeing a lot of evidence of that?
Well, so it's a little bit hard to be so sure of that. I mean, we do see, we don't document it in this report, but we show it in other reports that indeed countries like Mexico, countries like Vietnam import more from China, and the US is also importing more from them. So, of course, you suspect that there's some trade diversion, but we haven't really dug deep into that in this particular report.
How concerned are you about growing protectionism in the US? I mean, obviously, Donald Trump is threatening, should he be elected again, to really raise tariffs quite dramatically.
So for me, it's really a broader concern, and the concern is trade policy uncertainty. We have something like 50 elections this year, not just in the United States, but also in other parts of the world. And I sometimes say that the job of the World Trade Organization is similar to the job of the central bank. It's not just about inflation, but it's also about inflation expectations. And in our case, it's not just about trade costs, but also trade cost expectations, because that's what's going to affect investment decisions in international trade. So it's really important that we maintain the rules-based trading system that we stand for here at the WTO, because that's exactly what gives you this trade policy certainty.
From a very parochial UK perspective, the numbers are actually quite encouraging, particularly on the services side. I mean, UK services exports are growing very, very strongly.
Well, yes, and the UK is also looking good in digitally delivered services. So one thing that we've been seeing now for quite a while is a very strong growth in digitally delivered services. So things like, I mean, it could be all sorts of things, but things like accounting services, programming services, anything basically that you can send through computer networks. And the UK is doing very well. I think it's ranked number 2 after the United States in the ranking for 2023. So that's certainly financial services to the extent that they're digitally transmitted. I'm sure that's an important part of the story for the UK. So that's certainly a strength to build on.
A positive note on which to end on. We're out of time, I'm afraid. Ralph Ossa, good to speak to you this afternoon. Thank you.
Thanks so much for having me.
Some other business news stories for you now. And Tesco's chief executive said today that he's encouraged by signs of improving consumer sentiment as the UK's biggest supermarket chain reported a sharp rise in annual profits. Ken Murphy said inflationary pressures have lessened substantially, but that he was still conscious things were difficult for many customers. Well, he was speaking as Tesco reported an adjusted operating profit, which is its preferred measure, of £2.83 billion for the year to the end of February. That was up 11% on the previous 12 months. At a headline level, pre-tax profits jumped from £882 million last time to £2.3 billion, although that was largely due to a big impairment charge this time last year on the company's property assets. Tesco shares currently ahead by nearly 4%. KPMG has been hit with a $25 million fine by the US accounting watchdog after hundreds of staff in its Dutch business were judged to have cheated in professional exams. The Public Company Accounting Oversight Board said KPMG Netherlands and its former head of assurance had failed to stop cheating on internal training exams between 2017 and 2022, including widespread and improper answer sharing. It's a record fine from the watchdog, which also said KPMG employees had misled it. The online beauty and nutrition products retailer THG says it's returned to sales growth as it reported a halving of half-year losses. The company, whose brands include Look Fantastic, Cult Beauty and MyProtein, said that although 2023 revenues were down 8.7% on 2022, it had returned to sales growth during the final 3 months of the year. Well, THG, which also owns the e-commerce platform Ingenuity, saw pre-tax losses fall from £550 million in 2022 to £252 million in 2023. I can tell you the shares are currently off by some 10%. The UK's under-fire National Air Traffic Control Service has hired the former Rolls-Royce chief executive Warren East to become its new chairman. Well, his appointment comes as NATS continues to face compensation demands from carriers such as Ryanair following a systems meltdown last August that left thousands of passengers stranded for days on end. Mr East, who earlier in his career was CEO of the chip designer Arm Holdings, is highly regarded for the way in which he steered Rolls, which derives much of its income from the time its engines are in the air through the pandemic. The advertising group M&C Saatchi has blamed a downturn in the technology sector and hesitancy among clients to commit to new projects after reporting a 10% drop in full-year pre-tax profits to £28.7 million. But the company, which last year embarked on a major cost-cutting programme, said it was optimistic of returning to growth this year. It cited recent contract wins with clients including Porsche, Adidas, Nike, Revlon and McDonald's. The shares currently off by some 2.5%. Now, Spain is planning to scrap its so-called golden visa scheme that grants residency rights to foreigners who make large investments in real estate. The scheme had allowed British people with holiday homes in Spain to circumvent rules limiting non-EU citizens to a 90-day stay without a visa. The Spanish Prime Minister, Pedro Sanchez, said ending the scheme would help make access to affordable housing a right instead of a speculative business.
Around here in Valencia, at least, the majority of the Golden Visa clients that we get are Americans. There are quite a few British people as well. The biggest takers, people who take up this are Chinese and Russians, but that's around the whole of Spain. They tend to concentrate in Madrid, Barcelona, and on the Costa del Sol, and maybe the Balearic Islands.
Well, I've been speaking to Borja Garcia-Egotxeaga. He's chief executive of Neinor Homes, which is Spain's biggest house builder. I began by asking him for his thoughts on the current state of the Spanish economy.
In Spain, we are constructing more or less 80,000 houses per year, which is 1/10 of the houses that were being made in Spain before the big financial crisis. And this represents more or less 40% if we compare in a per capita basis with the production of houses in UK, Germany, or US. So there is a big default of supply in the main cities of Spain. It's also under leverage because more or less the household debt to GDP in Spain now stands at 50%, while before the crisis was 80%. That is more or less the value that now you have in UK. And it is underpriced because now we are reaching the value of the houses, the price of the houses that we had in 2007. While in other European countries, more or less, you know that the price of houses has doubled. Yeah. If you put this together with the economic situation in Spain, Spain is growing at a rate of 2% more or less this year, 23, 24. And we are with employment rates higher than ever. We are in maximums. So this makes a robust demand in a context of very low supply. And this is why, even in such a heavy environment as the one that we lived last year with the high interest rates, with the growth of interest rates, it still made that in Spain we are selling all the houses that we built, and we are still increasing prices last year around 5%.
On the basis of what you've just said, I think house prices in Spain are about 30% lower than they were before the global financial crisis. When would you expect them to return to that sort of level?
Well, really, it's very asymmetric. If you look some cities like Madrid, Barcelona, Palma de Mallorca, prices are slightly above the financial crisis. What happens is when you look at the average value of the country, you have some cities that are losing population and they are not recovering prices.
Now, the Spanish government has just launched a Help to Buy scheme, €2.5 billion, I think they're spending on it. Do you expect that to have an impact on construction activity?
It will have somehow some kind of connection, but really you have to look that this Help to Buy is looking for work people younger than 35 years old. So the budget that the Spanish government has approved is 2,500 million euros. And that will cover more or less a population of 45,000 to 50,000 young people, and they will buy second-hand residences, but they will move the market.
You've just reported record margins with your results. Clearly, you've been able to pass on costs where you've seen them. What's happening to input inflation just now?
Regarding construction costs, the situation in year 23 was very flat. Really, the big inflation that we saw in construction started in the summer of year 21, and it lasted more or less 18 months, and it had a very big relation with the price of energy, of gas. Since energy decreased prices last year, we didn't experience heavy inflation, and that was one of the reasons why we could control margins last year also.
Now, the UK house building sector, one of their biggest bugbears is the planning regime. Is it any easier in Spain?
For the planning, well, the planning is horrible because it's very, very slow, and you have to be very patient, and you have to understand very well the market when you decide where you want to invest.
You mentioned just now the fact that construction activity had really declined since the financial crisis. I mean, normally where there's a gap in the market, someone comes in to fill it. Are there not new house building firms being formed?
Not really. Right now in Spain, it will be very difficult to build buildings above 100,000 houses. We had a lot of people working in Spain that was not Spaniards. A lot of people that was coming from some other countries from Europe, and they left the country when the financial crisis, and they are not going to return. They're in Germany and UK.
So do you have a skill shortage in the industry?
Yeah.
In terms of the proportion of homes that are owned by foreigners, I think it's now 10% of new builds. That strikes me as being quite low compared with how people over here would perceive it.
Well, really, it's a little bit more. In fact, more or less, the foreigners are buying between 15 and 20% of new houses now in Spain, of total houses in Spain. But really, if you look to some specific markets, for instance, in Alicante and the area of Valencia, it's almost 50% of the transactions are being done by foreigners. Also, other touristic places like Costa del Sol and Palma de Mallorca stands up to 30-35% of the transactions are being done by foreign people.
Well, still to come here on Business Live, I'll be taking you through how the markets would be doing this Wednesday afternoon. Stay with us.
I will always remember the atmosphere at the Shanghai protests. It was an electric mix of excitement, fear and defiance, and a sense that history was being made.
We beg you to let Madeleine come home.
Memorable story was, and still is, the disappearance of Madeleine McCann.
I've seen people who believe and strive for the American dream, even in the face of disaster.
Play Sky News.
From the Sky News Centre at 7.
Now that you're up to date, we can go into a bit more detail.
Things can change incredibly quickly.
Taken by surprise.
Have you ever known a moment like this in British politics before? Yes. Cheers. We'll start with breaking news.
Let's get the latest on the ground.
So, by the end, we'll hopefully all understand what's going on in the world just that little better.
I'm Katie Spencer and I'm Sky News' arts and entertainment correspondent. As a team, we've interviewed some of the biggest stars in the world, the likes of Tom Cruise, Brad Pitt, Sir Elton John. We try to give you an honest sense of how these people really are.
You want to talk business? Meet me in the On-Board Lounge. Fly Emirates, fly better.
Well, the stronger than expected US inflation number for March has given the US dollar a real boost this afternoon. As you can see, sterling and the euro both off by more than 1% against the greenback. Single currency more or less unchanged right now against the pound. On the equity markets, this is how Europe has finished the session, largely in, well, it's been pretty mixed, actually, looking at that. Talking points this afternoon include Barry Callebaut, the Swiss cocoa processor, has finished up 11% in Zurich. That is on better than expected results. Here in London, FTSE 100 finishing in with its head above water. They're up a third of 1%, helped by gains, of course, for some of the big dollars. They tend to go up when the pound goes down against the dollar. The leading blue chip gainer in percentage terms this afternoon, though, is Tesco. That was up 4% at one point. It's finished up just over 3.25% higher. Outside the FTSE 100, quite a lot of stories around today. The chip components maker IQE is up 30% after a trading update highlighted an improving order book, while the outsourcing group Capita is ahead 3% or so. That's after it won a contract extension. Oh, look at that. It's only finished up at 0.75% in the end. That got a contract extension today from a major client. Meanwhile, Churchill China, company that we've had on this programme in the past, they're up 9% on their results. To the downside, Speedy Hire, again, another company whose CEO has been on the programme in the past, off 3.5%. That's on news that results will come in at the lower end of market expectations. Over on Wall Street, well, as you might expect, following that inflation number, all the main stock indices are lower right now. Nasdaq off just over 1% lower on the session so far. Talking points today on Wall Street include Delta Airlines. That's currently ahead by some 2%, and that is following quarterly earnings which came in ahead of Wall Street forecasts. As for the oil price, that's traded in a tight range today after yesterday's sell-off. Barrel of Brent crude, look at that, more or less unchanged, $89.40 a barrel just now. Well, joining me this afternoon is Roberta Barr. She's head of value ESG and a fund manager at Schroders. Roberta, afternoon to you. Obviously, the US inflation number, bit disappointing for a lot of people. How do you think this is going to impact on equity market investors?
Yeah, well, I mean, I think certainly, the hot news of the CPI increasing 3.5%, which is both on headline and sort of core CPI numbers hotter than expected. I think certainly a lot of investors aren't that happy today. Looking at the beginning of this year, coming into 2024, a lot of expectations from the market was basically for a near perfect US soft landing. So, steady US growth, falling inflation, multiple rate cuts this year. But actually, as the year goes on, certainly some of those near-term expectations are looking really quite unrealistic. We've already seen, even before today, in the past week or so, several managers cutting down their outlook on how many rate cuts we'll see in the US. Down from sort of 5 to 6 cuts at the start of the year to maybe, 1 to 2 quarter-point rate cuts in 2024. Whilst earlier this week that might have felt a bit gloomy, I think actually after today's data, you could argue it's pretty realistic to expect 1 to 2 cuts, and certainly, hopes of a summer rates cut are all but dead. But I guess November as the new hope.
Absolutely. I mean, I look at the data right now, Roberta, and one wonders why rate cuts are even being talked about at all. I mean, you had that really, really strong jobs number last Friday out of the US. Everything seems to be, well, getting quite hottish.
Yeah. I mean, I think the sort of CPI numbers coming out today really highlight two very interesting things about the equity markets today. So firstly, I think, highlights just how premature the markets have been in pricing in that sort of perfect soft landing scenario. And you can see consequences of that in things like, many indices hitting all-time highs again and again, whilst earnings are not hitting all-time highs. So, those highs are coming from increases in multiples rather than actual earnings growth or projected growth. And you can also see it in things like, equities rallying before the last Fed hike, rather than waiting for it to be announced as usual. And I think it sort of highlights how keen the market is to be optimistic. And whilst markets are exceptionally good at pricing in specific rate cut or inflation scenarios, actually there's still very much this sort of behavioural style element to play. And, you still get overexcitement, over-optimism, premature pricing happening. And it's just one of the many reasons why the markets continue to be absolutely fascinating.
Yeah. As you say, it does. Sorry, go on.
Oh, sorry. I just wanted to make the second point, which I think is really interesting about the CPI numbers as well, is that there's such a good reality check for what's actually happening in markets. So, within equities, it's all been about the Mag 7 in the US, or I guess today it's probably the Fab 5 or whatever it's being termed as. And, we've got a similar situation in the UK and Europe with granola, or whatever Goldman Sachs have called it. But actually, whilst at headline levels, markets, especially US equities, have been on an absolute tear for the past few years. That hides the fact that actually behind those big hitters, you've got this huge dispersion of valuations and sort of performance in the broader markets. You've got 7 companies returning over 100% last year, so 90% of S&P 500's return. It's quite easy to forget that actually, there are 493 companies in the index.
Indeed. Roberta, I'm so sorry. We're out of time, I'm afraid. I'm going to have to cut you off. Good to see you this afternoon. Thank you. That's it from me. I'm back at 11:30 tomorrow. Hope to see you then. Mark Austin's up next. Stay tuned. Cheerio.